Steve Brice is with us now. He's Chief Investment Officer at Standard Chartered Wealth Management. Steve, good to have you with us here. Thanks very much. I mean, the only question is whether inflation in the U.S. is so high that it causes a correction in the U.S. market. What do you think, Steve?
So I think, we're looking for a short-term pullback in US markets. Obviously, that's always a dangerous positioning to have because obviously markets generally trend up and to the right of any chart. But I think that the two key things, obviously, firstly, you mentioned the inflation piece as potentially a stimulus for that. We've been watching obviously what's been going on in the Middle East and the disruption to global trade flows through the Red Sea and through the Suez Canal. And clearly that is going to have a stagflationary effect to some degree. So obviously there is a growth impact. There's also an upside inflation impact. So that's something that we're keeping a close eye on and have been putting some short-term inflation hedges in our portfolio. We still think the big picture is for inflation to come down, but we could get some short-term disappointment. And the second thing is we're seeing very significant high level of positioning in US equities. So we look at our own proprietary indicators, also a lot of the indicators around in terms of market positioning, and they're all pointing to quite an elevated positioning in US equities at the moment. That overweight stance could lead to some short-term disappointment. I guess maybe looking back to the first point, the only risk is that we're not alone in looking for this. I think a lot of people are starting to talk about it over the weekend. I saw a lot of news reports, people flagging this risk. So we could still grind over higher in the immediate future. But I think, we wouldn't be adding to equity portfolios. In fact, we've been trimming a little bit so far this year.
Okay, you have trimmed a little bit from equity portfolios. I think that seems to be the narrative across the board, right? Not just in the US markets, but back home in India as well. What's your own sense of how Indian investors should approach it? Do you think raising some amount of cash levels is a prudent idea now, Steve?
The way we look at Indian markets, we expect both equities and bonds to outperform cash over the coming 6 to 12 months. So obviously, I think that the positive macro story is very compelling, probably more compelling on the equity side than on the bond side at the moment. But overall, we see the trend as being higher. And really, you do have that obviously the regular investment plans that people have in India does seem to put a consistent floor under the market. So we'd probably say that any weakness in the Indian market may be less severe than what we see in the US. Probably be a little bit less patient to add to Indian portfolios than we would be in the US.
All right. Hi, Steve. Good morning. Good to see you in. Nigel on this side. The last time you were telling us that it's hard to ignore China at these levels. So what would your allocation be in emerging markets? So, incremental money from here on.
Yeah, so it's really challenging, right? The China situation. We've obviously seen some decent data in terms of the amount of travel that's gone on over the Chinese New Year period, but then average spend still, quite subdued, certainly down from pre-COVID levels of 2019. And there is quite a lot of headwinds. So we talk about the positive narrative we have for the Indian economy. You have the reverse situation for the Chinese economy. There's a lot of negativity out there at the moment. Obviously, a lot of that's priced. And we could still see quite a decent bounce in Chinese equities. I think it's really dangerous to be underweight Chinese equities. We have around a 4% allocation in our growth portfolio at the moment to Chinese equities. We're not overweight. We have a neutral allocation, but that's around that 4%. But really to mark probably a long-term reversal of the downtrend, we need to see some positive policy responses generating inflation. To be honest, that's the key thing. We're slipping, it seems to be, into deflation. If that was to become a long-term phenomenon, then I think that would be a massive headwind for the market on a longer-term basis, regardless of the cheap valuations we're seeing at the moment.
All right. I don't know if you can pull up the Shanghai composite. I mean, because the Chinese market is back from a holiday. Hang Seng, of course, was trading last week. And Hang Seng, I think, did well. I mean, that's a proxy for what the mainland China stocks do. And that did well. But the Shanghai composite, Shenzhen, etc., will try and have those indices up as well. Steve, great speaking with you. Thank you very much for joining us here on CNBC-TV18. It's a pleasure, as always.